Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day at 8 a.m. In this video, I am going to walk you through the process of valuing BGC Partners stock by analyzing its financial statements and dissecting its financial ratios so we can determine if it's a buy or a sell. BGC Partners operates as a global brokerage company servicing the financial and real estate markets. It was originally part of Cantor Fitzgerald, but BGC became its own entity in 2004. Let's get started with the model. This is a small cap company, market cap 1.5 billion. They're trading at $4.18 a share, and they have 317 million shares outstanding. Let's look at the financials. Free cash flow is all over the place. It's negative, positive, then negative, then positive. Free cash flow is how you value a company. You forecast the future free cash flows, and then you discount that number back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Net income is a profit and loss on the income statement. It's revenue minus expenses. And they do have positive net income every year. Revenue is the sales, and that's also up and down each year. This is the company's income statement I pulled off of Yahoo Finance. The top line is the revenue, the sales for the company. Below that line is the company's operating expenses. And then they have other income or expenses. They also have taxes. So they do have positive net income every year. So that's a good sign. This is the company statement of cash flows I pulled off of Yahoo Finance. And the top line is operating cash flow. So even though they had positive net income every year, they had negative operating cash flow in 2 years. And the way you calculate free cash flow, it's operating cash flow minus capital expenditures. And that CapEx is between $75 and $95 million a year. So they have positive free cash flow in 2 of the 4 years. The company seems to be using a good amount of debt and equity to fund its business. Capital stock of $15 million in 2016, then $330 million in 2017, and another $330 million in 2018. They also issue a lot of debt each year, $300 million, $10 billion, $600 million, and $700 million. But it seems like most of the debt issuance is to roll the debt, which means they're issuing debt just to pay off the old debt. And the company has $1.3 billion of debt and $717 million of net debt. Net debt is debt minus cash. That means if they used all the cash on their balance sheet to pay down some of their debt, they would still have $717 million of debt left over. And they have $744 million of equity, and their WACC is 9.3%, which is a blend of the cost of debt and cost of equity, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's $694 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $900 million. We divide that by 317 million shares. And we get a calculated stock price of $284. They're trading at $418, so they're trading at a 47% premium. It's a sell according to the model. Simply, Wall Street's valuation is lower than me. They're at $133 a share. This is where the stock has been trading at the past 5 years, and it looks like it was trading much higher a couple of years ago, but the stock has been on a decline ever since. The company did a 3-for-2 stock split in 2018. That means all the numbers on this chart before December 2018 were 50% higher on the day they were trading. And the company pays a 1% dividend yield. They pay 1 cent per share per quarter. If you invested $10,000 into this company 10 years ago and you reinvested the dividends back into the company, you'd have $17,400 today. And if you did not reinvest the dividends, you'd have $15,800 today. On September 11th of each year, this company holds a big charity fundraiser, and they actually have famous people, athletes, celebrities, politicians come into their business and talk with their clients to try to raise money. I'm sure everybody in this video is familiar with 9/11. I was actually working in Manhattan the day of it happened. I was working in Midtown, but I was working in the World Trade Center for a few years, but before 9/11. And BGC Partners was part of Cantor Fitzgerald, and I believe Cantor Fitzgerald lost the most employees of any company in the World Trade Center because they had many floors on the top of the building. BGC's customers include the world's largest banks, brokerage houses, investment firms, hedge funds, and investment banks. The company's top 10 customers account for 30% of its revenue. Let's look at the financial ratios. The average PE in the market is 13.3, the median is 14.4. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 23.8, so they're doing a little worse than the median and average. Average price of sales is 6, the median is 2.2. Price of sales is stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. They're at 0.7, so they have a really good price-to-sales ratio. The average price to book is 4.6, the median is 2.3. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. They're at 1.8, so they have a really good price to book ratio. Equity is assets minus liabilities on the balance sheet, but their tangible equity is negative $171 million. This implies most of their assets are intangible assets, and that's generally not a good thing. The average interest coverage ratio is 12.8, the median is 3.8. Interest coverage ratio is EBIT over interest expense. They're at 21, so they can easily cover their interest payments. EBIT is earnings before interest and taxes. The average ROE is 10%, the median is 11%. ROE is net income over equity. They're at 7%, so they're a little lower than the median average. This is the only video I've done with a company in the industry, capital markets, so I do not have anybody compare this company to. But let me know what you think of the video. Give the video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.